Markets don't collapse the way most people imagine. They don't always crash with panic, chaos, and screaming headlines. Sometimes they simply stop working. Prices still exist, screens still glow, assets still technically have value, but something essential disappears: buyers. Liquidity is the invisible force that keeps financial markets alive. It's the reason you can sell a stock, exit a trade, or move capital without thinking twice. It's the quiet assumption behind every transaction, the belief that someone else will always be there on the other side. As long as liquidity exists, markets feel safe. When it vanishes, everything changes. Liquidity is not confidence, and it is not capital. It is willingness. The willingness to buy, to lend, to take the other side of a trade. It exists not because rules demand it, but because participants believe conditions are stable enough to act, and that belief is fragile. In calm times, liquidity feels infinite. Assets trade smoothly. Bid-ask spreads stay tight. Large transactions barely move prices. The system appears deep, resilient, and well-functioning. This illusion of depth encourages risk-taking, leverage, and complexity. But liquidity is not permanent. It is conditional. It depends on trust. Trust in prices, trust in counterparties. Trust that tomorrow will look roughly like today. When that trust weakens, liquidity doesn't decline gradually. It evaporates. The moment uncertainty crosses a critical threshold, buyers step back. Not because assets suddenly lose all value, but because nobody wants to be the first to discover how low prices can really go. Selling continues. Buying pauses. Spreads widen. Markets become unstable not from action, but from hesitation. This is how liquidity disappears. And when it does, markets stop behaving rationally. Assets that were considered safe become impossible to sell without deep discounts. Prices gap lower, not because fundamentals changed overnight, but because there are no bids. Forced sellers meet empty order books. Margin calls accelerate selling. The absence of buyers becomes self-reinforcing. Liquidity is confidence translated into action. Without action, confidence is meaningless. History offers repeated lessons. In every major financial crisis, liquidity vanished before prices fully collapsed. It wasn't fear that caused the damage. It was the refusal to participate. Banks stopped lending to each other. Dealers stopped making markets. Investors sat on cash, waiting for clarity that never arrived. Liquidity crises don't announce themselves loudly. They reveal themselves in silence. Phones stop ringing. Trades stop clearing. Credit lines freeze. Suddenly, institutions realize that assets they counted as liquid are anything but. Balance sheets that looked strong under normal conditions become fragile under stress. This is where modern finance becomes especially vulnerable. Today's markets are deeply interconnected and heavily leveraged. Liquidity is assumed, modeled, and built into every strategy. Risk calculations depend on the ability to exit positions quickly. Portfolios are constructed under the assumption that markets will always be there. But liquidity is not guaranteed by math. It is guaranteed by behavior. And behavior changes fastest under stress. When volatility rises, market makers pull back. Algorithms reduce exposure. Risk managers tighten limits. What once looked like deep liquidity reveals itself as a thin layer resting on top of leveraged positions. Once that layer cracks, there is very little underneath. This is why liquidity crises feel sudden and violent, not because something new appeared, but because something familiar disappeared. The danger of vanishing liquidity is that it turns manageable problems into systemic ones. A solvable loss becomes a forced liquidation. A temporary shock becomes a cascade. Institutions that could survive price declines fail because they cannot transact. Liquidity is the difference between loss and collapse. And once it disappears, restoring it is extraordinarily difficult. Central banks can inject money. Governments can guarantee assets. Regulators can suspend trading. But none of these actions instantly restore willingness. Trust must be rebuilt, and trust takes time. During that time, damage accumulates. Markets freeze not because participants don't know what to do, but because every move feels dangerous. Buying feels reckless. Selling feels irreversible. Doing nothing feels safest, and that is precisely the problem. Liquidity crises expose a truth that is easy to forget in stable times. Markets are social systems. They function because people collectively agree to participate. When that agreement breaks down, no amount of infrastructure can force it back into existence. This is why liquidity is always the final warning sign. Before prices collapse, liquidity thins. Before systems fail, transactions slow. Before panic spreads, silence takes over. And by the time everyone notices, the buyers are already gone. The most unsettling part is that liquidity rarely disappears because of a single dramatic event. More often, it fades due to accumulation, rising uncertainty, increasing leverage, tightening conditions, and growing doubt. Each factor alone seems manageable. Together, they change behavior. No announcement is made, no alarm is triggered. Participants simply stop stepping forward. And once that happens, the market's true depth is revealed. Liquidity doesn't vanish equally. It disappears first from the edges, complex products, lower quality assets, opaque markets. Then it moves inward, reaching assets once considered untouchable. What survives longest is not what is safest, but what is most trusted. When trust collapses, even the strongest assets can freeze. This is why liquidity crises are remembered long after prices recover. They leave scars on behavior. They teach institutions what it feels like when exits disappear. They reshape regulation, risk management, and strategy until memory fades and the cycle begins again. Liquidity is the system's oxygen. You don't notice it while it's there. You panic when it's gone. And the most dangerous moment is not when markets are falling, it's when no one is willing to catch them. Because when liquidity disappears, the market doesn't crash. It stops. And what happens next is never gentle. Welcome to Cash Chronicles, where money, power, and history collide.